We're looking at 5 undervalued dividend kings to buy now for long-term growth. Now, before we start today's episode, we have a list here of all the dividend kings in 2024 in their different sectors, as well as the years of dividend growth. Just as a reminder, a dividend king is a company that has been increasing their dividend for at least the last 50 years or more. As we can see here, there are quite a few. So in today's episode, we are picking 5 undervalued ones to consider in the portfolio for the very long term, for not just share price growth, but also growth to the dividend year on year. We'll look at the historical performance of each one. As always, we will look at their dividend safety, look at their underlying financial metrics, and we'll put every single one into the valuation model. We want to find out what is our own intrinsic value, what is our acceptable buy price, given our investor margin of safety, and what is Wall Street estimating for the upside over the next 12 months. And if you stick around towards the end of the episode, we are going to do an updated look at this ETF for those that don't want to buy individual stocks. It is the KNG Dividend Monarch ETF, where essentially it holds over 30 companies that have increased their dividends for over the last 50 years or more. So do stick around to hear our analysis on this ETF for the portfolio. So let's jump into the first undervalued dividend king. Straight away, we want to point out a double buy rating, Seeking Alpha and Wall Street. We do see Quant giving it a hold currently. And over the last year, they are down around 5%. When we extend it over the last 10 years, we do see they are up 166%. And just something as more of a note, this does not include those dividends reinvested. So if you are someone who does continue to reinvest those dividends quarter on quarter, it would be slightly higher. And we do note all-time highs December 27, 21 at around $140. Now, when we look at the current trading price, it is right there in the mid to lower end of the 52-week range. It does have a yield just over 2% at 2.1 and currently trades at a forward P of 22.62, not far off the current average of the S&P 500 as of today's price. So let's jump into the dividend safety and the metrics. Straight away, we have a very safe score, so looking good. 90 as well. In terms of market cap, 182 billion. It is a mega cap company. Now, in fact, just a few days ago, it was reaffirmed this dividend safety score, so we can see a dividend cut does look to be highly unlikely. Now, when we continue into the key metrics, just to let you know, this is from the last recession, so they did in fact continue to increase it during the 07-09 crash. Plus 3.9% recession sales, significantly above the average of the S&P at negative 12. And we also note some very strong performance, negative 13% in the last recession, significantly outperforming the S&P with their negative 55% return. Dividend growth, well, quite nice to note. In December last year, 7.8. It is above the 4% we advocate always on this channel to at least keep up in line with inflation. Over the last 5 years, we do see double digits. And over the last 20 years, at a bare minimum, they are increasing those dividends in line with inflation. In terms of looking at their growth, well, we do know they have been increasing those dividends for 52 years, whilst in fact paying a dividend for the last 100 years without a reduction, something phenomenal to say the least. In terms of looking at dividend yield theory, as always, it states the company is undervalued when the current yield sits above the 5-year average. So we have a signal here of undervaluation. In fact, in today's episode of Abbott Laboratories, we have a double undervaluation signal. Forward P of 22 is below the 5-year average of 25. When we do compare it, however, the healthcare sector P does sit lower at 16. Just remember, though, it is a quick note that we don't look at any of those models in isolation, and we'll conclude towards the end. In terms of the free cash flow payout, just a note again, free cash flow over the earnings, it is susceptible to manipulation by management through accounting, and we can spot a lot better, in more clarity, any potential dividend cuts by looking at this metric. Below 60%, as always, giving us faith they can offer those strong double-digit increases we love to see. Now, we do know it is higher in 2023 at 72%. The positive to take over the longer term, it is below 60%. 2024 expected as well at 38%, so a good sign. And remember, with free cash flow, ideally look and invest in companies that increase it on a year-to-year basis, or at least over the longer term. We do note this with ABT, but there is a little bit of inconsistency. Nice to note, 2024 full financial year expected to increase sharply. In terms of sales growth percentage-wise, when we do our in-depth analysis, 3 to 7%, We can see for the large part it is between there, although we can see last year was a very poor year, down -8%, and the share price also reflects that. Numerically speaking though, we can see they have doubled their top line, 20 to 40 billion in 2023. One of the things we'd love to see with companies is when they do those share buybacks, returning the excess cash. What we know with Abbott Laboratories, they would have diluted your position over the longer term, as we do see it increase to 1.53 billion to 1.75, something to factor into your own analysis. ROIC, very important, personally above 10% or 10 at a minimum, just so that we are aware that management are able to effectively allocate their capital, something they have done over the last 4 years, and in fact for the majority of the last 10, so this is a good green tick when we are analysing this. In terms of the margins, operating and free cash flow, well, we do know some operating efficiency as it has increased over the longer term, also consistently above the minimum 12%. Same to be said for the free cash flow, very consistent, looking very healthy, and it does make it attractive to those investors. Net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, as always correlates to dividend safety, balance sheet strength, below 3 as our blanket rule, and this is because it gives us, or in fact shows us, the number of years it would take the company to pay off all of their debt net of cash on hand. Very low, 0.82 in 23, 0.71 expected next year, so it's expected to go even lower. No issues with the dividend safety, no issues with the balance sheet strength for now, so let's jump into the valuation. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now let's jump into the valuation. As always, we do deep dives, we do run through every single one of these models. Today's episode, let's just jump straight into the calculation, which is the average of these three models, coming to just over $129 in today's episode. As always, we do start with 10% and we execute on that if it meets the three criteria of a wide moat, strong financial metrics, and good forward-looking data. 116 at a 10% MOS level, 15% 109, 67, 20% it isn't actually that far off. So in today's episode for Abbott Laboratories, we do see around a 15 to 20% margin of safety for this dividend king. In terms of Wall Street and their expectations, well, they see 30% upside over the next 12 months. So they do see this as a strong buy, and we can see a 136 price target, slightly higher than our intrinsic value. As always, let us know your thoughts as we do go along with these stocks today. The next undervalued dividend king is a new one that we haven't reviewed on this channel, and we want to draw to your attention a strong buy from Wall Street, a 5 out of 5, the highest score obtainable, so they do believe this is one to definitely consider for the portfolio. It is Middlesex Water Company, a utility company, down 22% over the last year. Over the last 10 years, however, we do see it up 188%. All-time highs we do see again back end of 2021 at $120, pretty much double the current trading price. Right now it trades essentially in the mid to lower end of the 52-week range with a forward yield of 2.25% and a forward P of 25.17. In terms of dividend safety, well, 91, very safe, 1 billion market cap, a small cap company. And when we do take a look, again, reaffirmed in March that this is very safe, dividend cut highly unlikely. Last recession, well, they increased the dividend. They had pretty much flat sales, but again, above the average, and they outperformed the S&P with their negative 35% return. Dividend growth, well, at a minimum, they kept it up in line with inflation, a little bit better over the last 5 years. However, over the last 20, it has been increasing 3% year on year. As we mentioned, a dividend king, in fact, a fairly new one with 52 years of consecutive increases. And when we do take a look at dividend yield theory, again, we see a double undervaluation signal, 2.21 versus 1.53. And we also know a forward P of 26.6 when the 5-year average has sat at around 32.3. Still, however, it is higher than the utility sector of 16.1. Now, like we did with Abbott Laboratories, we will look at their payout ratio. However, because it is a utilities company, free cash flow a lot more volatile. We draw your attention to the earnings payout below 75% for the target for water utilities. Below that every single year, so looking very strong. 2024 expected to go lower to 59%, so looking very healthy. In terms of the EPS, well, what we want, similar to when we looked at free cash flow per share, we want increases year on year. What we do note, it does increase over the longer term, that given this cyclical industry, we can in fact see some years has decreased and then rebounded straight after. 2024, we are expecting an increase to 221. If you want to see here, this is just the percentage format, and we do note 2023, it was down negative 17%. 2024 expected high single digit growth to that EPS. In terms of sales growth, again, you can see the cyclicality element, minus 2%, minus 3% over the last 10 years. Last year, however, around 2% to their top line. The year before that, we did see double digit. And numerically speaking, always understand the type of companies you're investing in and the expectations. This isn't one that is a fast growing company, but we do see over the longer term, it is increasing. In fact, with utilities, we do expect them to dilute your position. Actually, quite nice to note that it hasn't been as fast as maybe others in the industry, so that is a positive sign. The reason for this is they do rely on this to fund a portion of those growth expenditures. In terms of ROIC, we do lower this a little bit to around the 7 to 8% level for water utilities. We do know over the last 5 years around the 5 to 6% level, a little bit lower than what we like to see, but hopefully we can see them turn the tide and increase this year on year. In terms of operating margin, well, above 18% for water utilities. We can see fairly consistent year on year. Has decreased over the longer term marginally, but on the trailing 12 months at 27%, that is a positive sign. When we look at the net debt to EBITDA, then remember the earnings before the interest, tax, depreciation, amortization. We increase it to 5.5 for water utilities. Now, it has been above that in 2023, the last 12 months, so trailing around 5.73. Ideally, we would like to see this come down a little bit, but given that the payout ratio is fairly low, that dividend does look to be safe. Just something to keep an eye on, as we don't want it to get any higher. In terms of the valuation, then let's jump straight into it, and it is in today's episode the average of these models. And remember, you can grab a copy of this valuation model by clicking on the pinned comment below, getting to both the intrinsic value as well as the acceptable buy price of those in your own portfolio as well as those in your watch list. Now, margin of safety of 10%, we pretty much see it is trading around that $58 mark, $57.95. So today's episode, an MOS of 10%. When we look at Wall Street, well, as we said earlier, they do believe this an incredibly strong buy. They had a 5 out of 5, something we very, very rarely see on Seeking Alpha. Upside of 29% and a price target of $75. Do let us know if the utilities is something you do like us to do a review more of, as there are a lot of other utility companies that we can also deep dive into. The next dividend king that we are drawing your attention to is National Fuel Gas. It is a double buy rating, a Seeking Alpha Wall Street with Quant giving it a hold. It is trading towards its 52-week high, a forward yield higher than the previous two at 3.47, but it does have a much lower forward PE of 11.85. Over the last year, it is up 6%. Over the last 10 years, we do, however, note it is down 23.7%. We do see all-time highs around $75 around 2 years ago. In terms of the dividend safety, well, a triple very safe score, 95, market cap 5.25 billion, a mid-cap company. We also note the reaffirmation of that very safe score, and we do see the key metrics in the last recession. Well, they increased the dividend, even though they had below average growth, they did slightly outperform the S&P with their negative 40% return. Nice to note, at a bare minimum, it is in line with inflation, although over the last 5 years and the last 20 years, we do note it has dropped to around that 3% level. Ideally, we do want to see that 4%. They've not only been increasing those dividends for the last 53 years, but they have been paying a dividend for the last 122 years without a reduction. So again, very, very impressive with this dividend king. Now, in terms of looking at dividend yield theory, we do note a fairly reasonable valuation. The yield isn't too far off the 5-year average. Likewise, the same can be said for the forward PE, although we do note it is much lower than utility sector of 16.1. So when we take a look at the earnings payout, remember we do focus on this for utilities, significantly below 75% year on year, 39 expected in 2024 for the full year, so looking positive. We also note increases to the earnings per share over the longer term, although we do want to draw out that next year is expected to be a smaller drop. And again, for those that do prefer the percentages, we can see the cyclical nature. Some years low growth, some years double-digit negative growth, followed by double-digit positive growth. And the same can be said for the sales growth that we can see here as well. Numerically speaking, though, in terms of their top line, we do notice it has gone from 2.11 to 2.17. So again, just something to factor in, not only your investment thesis, but also your MOS level. In terms of shares outstanding, then, not that bad in terms of the dilution, but again, something just to point out. When we take a look at the ROIC, a lot better than what we did see for the previous stock, significantly above 7.5 continuously and 11% in the more recent year. When we take a look at the operating margin as well, nice to note that operational efficiency over the longer term and consistently above that 18% minimum that we want to see for this industry. On top of that, we do note a very strong balance sheet, 2.26, significantly below 5.5, and it is expected to be around that in 2024. So in terms of the valuation for NFG, let's jump in, and today's intrinsic value is coming to a total of $66.36 with a current price of $57, 10% a buy up to $59.73, at 15% pretty much around that in today's price. So with a 15% MOS level, Wall Street are anticipating around 15% upside, $65.28 for this Dividend King, which has been paying a dividend for a significant number of years. And as always, let us know your thoughts in the comments below, whether or not you are considering or maybe have been adding to any of these kings. We then move on to the next Dividend King, which we have a double buy rating and a strong buy rating. It is AbbVie Incorporated. Now this is up over 11% over the last 12 months. Over the last 10 years, up around 200%, and we can see, in fact, it is trading towards the midpoint of the 52-week range, with a nice starting yield, 3.86%, and a forward P sitting at just over 14. Now, in terms of the dividend safety and 80 score, market cap 284 billion, it is a mega cap company with a dividend safety reaffirmed just days ago. In terms of looking at the key metrics, well, we can see recession sales looking very strong at plus 10%. In terms of dividend growth, well, above the inflation, but a little bit disappointing given the 9% over the last 5 years and the 14% over the last 10 years. And we do also see 100 years of paying a dividend without a reduction and 52 years of consecutive increases. Now, in terms of dividend yield theory, we do note the overvaluation sign as the yield is essentially below the 5-year with the forward P above the 5-year. And when we compare it, it is marginally lower than the healthcare of 16. But as always, we're not looking at any of these in singularity. So we go back to our valuation through the free cash flow method, and we can see here that below 50% for biotechs, pretty much straddling around that year on year, expected to be marginally higher in 2024, so no worries with that there. We also note some very nice growth over the longer term in terms of the free cash flow, although a small drop into 2024. And when we take a look at the sales growth, pretty much better than the 3-7% we want every year, although we can see the more recent year a drop to their top line of negative 6%. In terms of speaking numerically, well, they have more than doubled their top line, 20 to 54 billion, but we do have to inform that they have been diluting your position as a shareholder over the longer term, although you could argue it is very minimal. When we look at the ROIC for biotechs, a very high number that we go to around 25%. Some years they have hit it, some years they haven't, but whenever they haven't, bar 2020, they haven't been too far off, so no red flag indicators to note. And when we look at both operating margin and free cash flow margin, very strong, operating above 25% continually, free cash flow pretty much the same with some very high numbers in the low 40s just in the last 2 years. In terms of net debt to EBITDA, well, we can see for biotechs, we do bring it significantly lower, 1.85 in 2023, 2.07 in 2024. So whilst we do want to see it lower, we can understand why this has been giving a safe dividend score as opposed to a very safe. But overall, no red flag indicators, but something we can just keep an eye on in relation to their debt levels. So in terms of the value for this company, the essential intrinsic value is arriving at around $200.33. With the current price quite some way off, this should have some very nice margin of safety. At 15%, 170, at 20%, pretty much at the current trading price for this Dividend King. Now, when we take a look at Wall Street, well, they're anticipating around 16% upside. They have a price target of $187, and this is one that I do hold myself as well. I do believe it is a great long-term stock, but as always, let us know your thoughts below. The next Dividend King is one we had to include purely for the fact it got a double strong buy rating, including one from Wall Street, as well as a Seeking Alpha buy, but it is essentially at the upper end of the 52-week range. The yield is around 1.82% and a forward P just below the S&P of 21.21. It is up around 39% over the last year. Over the last 10 years, it is up around 73%. This is Emerson Electric Company. Now, in terms of looking at the dividend safety, a 78 safe score, market cap 66 billion, a large cap company. We do see a reaffirmation of that safe score, and in the last essential recession, they did increase the dividend, they had below average growth, and they also had a near S&P return. In terms of looking at the dividend growth, not the greatest, 1% over the last 5 years as well. Over the last 20, however, 5% above inflation. Ideally, we would like to see that come back, especially in the shorter term. We do, however, note 66 years of consecutive dividend increases. So when we take a look at dividend yield theory, we do see an overvaluation signal on the yield. Forward P pretty much in line with the 5-year average, and when we compare it to the industrials, it is pretty much in line around that 19.6 number. In terms of looking at the metrics, well, in the free cash flow, we do see it is below 60% for the large part. However, in 2023, it was significantly higher, which is a red flag indicator. It does show us that management paid out more in dividends than they generated in free cash flow. However, nice to note, 2024 it is expected to come down to 39%. When we move on to the free cash flow per share, very, very inconsistent, although again, cyclical nature of the industry. We can see over the longer term, very minimal movement in terms of growth. In fact, 2024, a very large increase of 537 to 2023's 48 cents per share. When we look at the sales growth, again, not much to say other than the cyclical nature. Some years negative, some years positive, and this is also reflective when we look at the growth in sales in terms of numeric format. What we do know, however, with this company is they have been doing those share buybacks, reducing the count from 704 to 574 in the latest quarter. So that is nice to see, even if we don't get those inflationary increases to the dividend. ROIC, something to keep an eye on because it has been decreasing over the longer term. As always, we do want to see 10% as a minimum, but we can see the last 2 years it has fallen below, as well as the decreasing trend. Nice to note though, operating margin looking healthy, fairly consistent around the 20s to the high teens. When we look at the free cash flow margin, other than 2023, it was looking very strong. Something to keep an eye on, but nice to note the trailing 12 months of 6% is a positive sign for this dividend king. Finally, we get to the net debt to EBITDA, very low in 2023, although it is expecting a rebound higher in 2024. Still below 3 though, so we can understand why this dividend does look safe for now. But as always, just a few things to keep an eye on quarter, year on year. In terms of looking at the valuation, don't forget, as always, you can grab a copy of this model by clicking on the pinned comment below and running your own companies through, as well as those on your watch list. So our intrinsic value in today's episode at 120.54 is the average of the 3 that you can see. Now, this is one that doesn't currently yet have a 10% margin of safety. It does sit pretty much at a 5% at 114.51. However, we felt this was one we had to include given the double strong buy rating we saw earlier, including Wall Street as well. In terms of their forecast over the next 12 months, they do see upside of 17% for this company that's provided and been very strong for shareholders just over the last 12 months. $135 as their price target. But as always, let us know your thoughts below whether or not this is one maybe you already hold or one you will consider if the share price does start to drop. As we did mention at the beginning of the episode, for those that do prefer to invest in ETFs rather than essentially looking at individual stocks that do go through some phases where they do grow rapidly and then fall rapidly, you may be wanting to take a look at this ETF. As we said earlier, it is essentially a Dividend Monarch ETF, KNGS. Now, this essentially is, as we can see, the only ETF to invest in dividend monarchs, which they do believe is an elite group of over 30 companies with 50 years or plus, in fact, of increasing those dividends. Now, they say, why would you want to? A few reasons in terms of investing in an ETF as well as these, but they call them blue chip leaders, and they do say they are amongst some of the well-known and established companies in their respective industries. But just something to consider, not all of these have performed strongly, and we can see they do have defensive qualities for those that essentially do want to avoid any larger market downdraws. Now, in terms of what is within this ETF, well, the top holdings, in fact, the largest one that we see is 3M, 5.23% holding. They have Black Hills Corporation, just under 5%. We have Sonoco Products, we have Federal Realty Trust, and then we have Kenvue here as well at 3.84, as well as a few others. In fact, we did also just review National Fuel Gas. Now, again, it does depend whether or not your preference as an investor. Let me know your thoughts below. Do let us know if there are any other ETFs you do want us to review that are fairly similar in relation to this one. And in terms of their performance, well, this is one that is fairly new. So when we do take a look, we have to see since inception, which as we can see here, wasn't too long ago. It is up around 15.91%. As always though, do let us know your thoughts in the comments below. Last thing that we do want to say is that we have released our latest free weekly article. If you do want to gain access to this or any others, all completely free, do click on that pinned comment below. You can start reading this straight away, instant free access, and we just want to draw your attention to this article here where we do run through essentially all of the resources, all of the websites that we go through for all of our analysis. As always though, if you have enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts in the comments below, and as always, we'll see you all on the next one.